Why oil prices are rising, what it means for the global economy. Oil prices are once again at the center of global attention, and for good reason. From rising gas prices at the pump to increased costs of goods and services, oil plays a critical role in shaping the world economy. But what exactly is driving oil prices higher, and what does it mean for investors, businesses, and everyday consumers? To understand this, we need to start with supply and demand. Oil is one of the most traded commodities in the world, and even small disruptions in supply can cause major price spikes. One of the most important regions for global oil supply is the Strait of Hormuz. Nearly 20% of the world's oil passes through this narrow waterway. Any tension or conflict in this area can quickly send shockwaves through the market. Geopolitical tensions, especially involving countries like Iran and the United States, often create uncertainty. When investors fear that oil supply might be disrupted, they begin buying oil futures aggressively, pushing prices higher. Even rumors of conflict can lead to significant volatility in oil markets. Another key player in oil pricing is OPEC. This group of oil-producing nations controls a large portion of global oil supply. When OPEC decides to cut production, oil prices usually rise due to reduced supply. On the other hand, if they increase production, prices may fall. Recently, coordinated production cuts have contributed to upward pressure on oil prices. In addition to geopolitics and supply decisions, global demand is also a major factor. As economies grow, especially in countries like China and India, the demand for energy increases. More factories, more transportation, and more consumption all require oil. When demand rises faster than supply, prices naturally go up. Another important factor is inflation. When inflation rises, the value of money decreases, and commodities like oil often become more expensive. Investors also see oil as a hedge against inflation, which increases buying activity and further pushes prices higher. So, what does this mean for everyday people? The most immediate impact is at the gas station. Higher oil prices lead to higher gasoline prices, which increases transportation costs. This doesn't just affect drivers, it impacts the cost of shipping goods, airline tickets, and even food prices. In short, when oil prices rise, almost everything becomes more expensive. For investors, rising oil prices can create both risks and opportunities. Energy stocks often perform well when oil prices are high. Companies involved in oil production, refining, and distribution tend to see increased profits. However, high oil prices can also hurt other sectors, such as airlines and manufacturing, which rely heavily on fuel. There's also the question of how long high oil prices will last. This depends on several factors, including geopolitical stability, economic growth, and decisions by major oil producers. If tensions ease and supply increases, prices could stabilize or even decline. However, if conflicts escalate or demand continues to rise, oil prices may remain elevated. In conclusion, oil prices are influenced by a complex mix of supply, demand, geopolitics, and economic factors. Whether it's tensions in the Strait of Hormuz, decisions by OPEC, or growing demand from global economies, each element plays a crucial role. Understanding these dynamics can help individuals and investors make better financial decisions in an increasingly uncertain world.